Welcome to this installment of Clarifying Tax Situations with attorney and CPA David W. Klossing.
The only guidance really issued to date regarding cryptocurrency, Bitcoin, etc., is found in Internal Revenue Bulletin 2014-16. In the bulletin, the IRS defines virtual currency as currency that can be used to acquire goods and services or held for investment. Actually, to date, it has almost any function that normal cash has. They define virtual currency as a digital representation of value used as a medium of exchange or to store value, and they admit that cryptocurrency has some functions like real currency of the US government and many other foreign jurisdictions. Cryptocurrency, while it functions like legal tender, does not, to this date, enjoy the legal status as legal tender in any jurisdiction within the United States or elsewhere. The bulletin defines convertible virtual currency, Bitcoin for example, as having an equivalent value to real currency and functions as a substitute for real currency and can be digitally exchanged between buyers and sellers, purchased via or exchanged into US dollars and many other foreign currencies. The common U.S. federal tax consequences related to virtual currencies are as follows. At present, virtual currency does not generate foreign currency gain or loss when exchanged between countries. This is one of the advantages. A Bitcoin in U.S. dollars has the same value as a Bitcoin in Chinese dollars. A taxpayer who receives virtual currencies for either goods or services must include the fair market value of the virtual currencies received in US dollars at the date of receipt. This is why record keeping is so important. If something is acquired with virtual currencies, the basis of that acquired asset is the fair market value in US dollars at the date of payment or receipt. When valuing virtual securities, look for an exchange that lists the market supply and demand and the changing fair market value on a daily basis of the security you're trying to value. Determine what that fair market value is on the date you're trying to come up with the valuation, convert it to US dollars per coin at the applicable exchange rate, and this will most likely be considered a reasonable and consistent manner for valuation purposes. When cryptocurrency is exchanged for property, a capital gain or loss may have occurred. Where the fair market value of the property received exceeds the taxpayer's adjusted basis in the currency he spends on it, the virtual currency, the Bitcoin to cryptocurrency, the taxpayer has incurred a capital gain. Cryptocurrency is a capital asset. When you exchange it or sell it, you have capital gain or loss. The way to think about capital gains and losses are you have to look at holding period. If you've held it for a year or longer, you can enjoy the long-term capital gains rates, which are currently 0%, 5%, 10%, 15%, 20%, or 23.8%. Okay? All it takes is $250,000 of capital gain activity in 1 year to get into the highest capital gains rates, which are 23.8%. On the other hand, if you spend a Bitcoin or cryptocurrency that's been held for a year or less, any capital gain or loss will be short-term, and in that case, you look at it just as ordinary income subject to the normal tax brackets. The highest bracket for 2018, for example, is 37%, which is way in excess of 23.8% if it were the highest capital gain rate. California, by the way, doesn't make a distinction between long-term capital gains, short-term capital gains. Everything's taxed at the marginal bracket. Highest bracket is right around 13% for individuals. In contrast, a capital loss occurs where the fair market value of the property received is less than the adjusted basis of the cryptocurrency spent on the asset. The character of the gain or loss generally turns on the character of the virtual currency in the hands of the individual taxpayer, whether it's a capital asset in their hands or an ordinary asset in their hands. Okay? When you invest in cryptocurrency, you're going to get capital asset treatment. When cryptocurrency becomes inventory of a business, like in a money service business, all gains or losses are ordinary and no capital gain treatment will be extended. Again, virtual currency held as inventory in a trade or business is not a capital asset. It will generate ordinary gains or losses. Where a taxpayer mines cryptocurrency, the fair market value of the virtual currency they receive at the time of receipt is includable in gross income, subject to self-employment taxes and ordinary income tax brackets, because it's really the provision of a service in exchange for compensation, similar to how people are paid on a 1099. This will be reported on Schedule C, and the reasonable expenses of generating that currency should be deductible against it. The hardware, the paper, the office expenses, those sort of expenses can be offset against the mining income on a Schedule C. Only the net income from that activity will be subject to self-employment taxes and ordinary income tax brackets. The fair market value of virtual currencies received as payment in the capacity as a subcontractor or an independent contractor constitutes self-employment income and is subject to self-employment tax, similar to how miners recognize income. Where an employee is paid in cryptocurrency, the fair market value of the virtual currency they're paid is wages and is subject to self-employment tax and federal income tax withholding and must be reported on Form W-2. Let me make this clear. All payments made in virtual currency are subject to identical information reporting as to any other payment that is made in property or in cash. Payments made in virtual currencies to foreign payees are also subject to backup withholding requirements, as are other payments made in property or cash to non-resident aliens. A business, an organization, and an individual that interacts with a substantial number of unrelated third parties can be deemed a money service business. A money service business functions to settle payments between various merchants, individual customers, or cryptocurrency investors. If you do this, you're likely to be seen as a third-party settlement organization or a money service business. The danger here is if you function as a money service business and you don't register with the SEC and state authorities as a money service business, you can face incarceration or civil penalties. If you're classified as a money service business, you will face all the regulation of a bank or maybe even as a securities brokerage. The Bank Secrecy Act, responsibility for looking for and reporting money laundering, suspicious activity reporting, and 8,300 reporting requirements where a transaction exceeds $10,000 in cash. Third-party settlement organizations are also subject to 1099-K reporting requirements. A 1099-K shows the total payments that are made to an individual merchant during a calendar year by party on a 1099-K. This allows the IRS to check, hey, is this third party reporting all of their cash transactions? They'll compare total sales reported, for example, on a retail organization to the sum of the 1099-Ks. If the 1099-Ks add up to $5 million, but there's only $3 million worth of sales, the government's going to go looking for $2 million of unreported sales. I happen to note that 1099-K reporting is done by most cryptocurrency organizations, where most other 1099 reporting is not done. It's been my experience that US-based coin brokerages ordinarily will do 1099-K reporting, but no other types of 1099 reporting like 1099-B for sales of cryptocurrency by individual investors. Underpayments related to virtual currency transactions on a tax return are also subject to accuracy-related penalties, just like cash transactions would be. Failures of businesses and investors to correctly report virtual currency transactions, where they are required to, will be subject to information reporting penalties found under Code Sections 6721 and 6722. The current uncertainty dealing with virtual currency is best illustrated by the following link that I provide in my handout materials to an AICPA request to the IRS for further guidance in this area.